Hello and welcome to LIC's Pasture Profit Insights 2021. I am Sean Chubb, the lead pasture profit consultant for LIC in the UK. I'm pleased to introduce tonight's speaker, David Becker, owner and developer of Red Sky. David has had an extensive knowledge of what makes farm businesses profitable through having held leadership positions in large corporate dairy, beef and cropping businesses with enterprises in Australia, New Zealand, Uruguay, Chile, Romania, Poland, and Russia, including having been CEO of New Zealand Farm Systems Uruguay and CEO of Australia's largest dairy farm business. On top of this, David was also the principal in an agricultural consultancy business and developed Red Sky, an agricultural business analysis and benchmarking software that has been widely used in Australia, New Zealand, and South Africa. Before I hand it over to David, please be aware that you can post questions throughout the webinar by clicking on the Q&A button at the bottom of the screen. All questions will be answered at the end of the webinar. Now over to you, David.
The title of this presentation is Profitability Trends of International Pasture-Based Dairying and What Can the UK Learn? The subtext to my presentation is building more profitable and resilient dairy businesses. The presentation will cover the following. First, I'll outline some trends in dairy business performance for a number of countries. Then I'll identify a core group of ratios relating to profit and confirm the definition for financial resilience. Next, I'll review what the business impacts are of changes to pasture harvest, milk production per cow, and farm production system. Then I'll review the impact of climate variability or potential warming of the planet on dairy farm performance. I'll discuss what may be behind the trends in the UK and elsewhere with changing production systems. And finally, I'll draw some conclusions. My presentation is predominantly informed from two papers that I had published in 2020. The first of these was based on country comparisons titled Evaluating the Loss of Profitability in Declining Milk Production in the Australian Dairy Industry. The second paper was titled Key Determinants of Profit for Pasture-Based Dairy Farms and included the analysis of a large, unbiased database of Australian dairy business performance. Most of the country comparison slides are going to have a format similar to this one, and I've endeavoured to use some portion of national colours for each country. There were 6 countries analysed in my paper, with these being New Zealand in black, Australia in gold or yellow, United States in dark red, Argentina in light blue, Uruguay in dark blue, and South Africa in springbok green. For this presentation, I've added the UK in dashed light red and Ireland in lighter green for the milk production and milk price graphs. All graphs have the years on the horizontal axis, with these commencing in 2003 and going through to 2019 or 2020. All milk ratios are in litres, with this milk energy corrected to 4% fat and 3.3% protein to make the comparisons fully relevant. This graph is intended to set some context for the size of the dairy industry in each of the 8 countries. The US industry is roughly 4 times the size of the New Zealand industry, so the US production on this graph is just their export volumes. It can be a little sobering seeing how much additional milk a country like the US can add to international trade. This graph highlights the trend in milk production growth for each of the 8 countries, where 2003 milk supply for all is set at 1. All countries have been growing milk production except Australia, although some countries like Argentina and Uruguay have seen growth stall at times. I believe it's fair to say that all of these countries are experiencing similar challenges in regard to general environmental, societal, processing, marketing, and consumer trends. Farmers in all these countries complain about the unfair practices of supermarkets and big business, how their dairy processes are not efficient enough, and how weather events and potential changes to climate are impacting them. The UK's growth in milk production is comparatively poor, with an annual year-on-year growth over the last 18 years of just 0.6%, with all of the growth effectively coming since 2014. This is the same graph of milk production growth over the last 18 years, though trend lines have now replaced joining of the annual dots. This highlights how strong the growth has been in most countries, with the exception of the UK and my own country, Australia. For any country where farmers have the potential to increase milk production, then periods of low or no growth for an industry confirm that most farmers are lacking profitability and are unable to produce the cash or the confidence to deliver growth. The graph also highlights how growth in milk production has accelerated in Ireland once subsidies were removed. Ireland has really focused on maintaining a high percent of pasture in the cow's diet, so that cost of production was low and profit margin high compared to the European counterparts. Unlike in the UK, once quotas were removed, the Irish industry was in a position to profitably expand, as the upward curving light green line highlights. So what has been happening with profitability in the 6 countries for which I have full business performance data? These countries have a range of climates, while New Zealand, Australia, Argentina, and Uruguay are all major exporting countries, and South Africa and the US are more domestically focused. This graph has return on capital on the vertical axis, which is the ratio that defines profit. Clearly, South Africa in dark green is the outstanding performer. However, the first important point I want you to note is that in the highlighted period of 2003 to 2007, Australia in yellow, Argentina in light blue, and Uruguay in dark blue all had higher levels of profitability than New Zealand in black. However, by the end of the period, all 3 countries have consistently lower levels of profitability than New Zealand. This is the same graph as the previous one, though with trend lines added. 3 countries have been increasing profitability: South Africa, New Zealand, and the US in red. 3 have been experiencing declines in profitability: Australia, Argentina, and Uruguay. South Africa appears to be an anomaly, though the huge increase in profitability through to 2012 is linked to rapidly increasing pasture harvest, as you will see. So what is behind New Zealand's gradual improvements in profitability, and what is behind Australia's, Argentina's, and Uruguay's loss in profitability? Milk price is often the primary focus of farmers' concerns. This graph has milk price in US cents per litre of energy-corrected milk on the vertical axis. There are a number of interesting factors to highlight here. New Zealand milk price in black is the most volatile, given that country's almost total reliance on the export market. South Africa in dark green does have an advantage over the 4 export-focused countries through to 2011, which is what you would have historically been expecting given its domestic production focus, though this advantage has disappeared since 2011, and yet profitability has remained high. The US, UK, and Irish milk price is almost always significantly higher than for all the other countries, with the UK having an anomalously high price from 2017 to 2019, linked to the depreciation of the pound. The international market trends are clearer in this graph when trend lines are added. Although you might hope the linear trend for the UK's milk price might be real, it is based on a short-term anomaly and would be unsustainable. So this curvilinear trend might be closer to the reality. What is interesting is that where governments do not restrict market access, then milk price is now similar regardless of whether the country is export or domestic focused. For those countries where governments do interfere significantly in the trade of dairy products across their borders, such as the US and the EU, the premiums being paid to dairy farmers over and above the internationally traded value of milk has significantly decreased, and the difference in price is continuing to narrow. This change in the dynamics of internationally traded milk prices coincides with 2 major changes in international trade. Firstly, the emergence of China as a huge importer of dairy products, and secondly, the emergence of the US as a major exporter of dairy products. This is an important change for the UK dairy industry and will only be heightened with Brexit, in that the historical milk price premium UK farmers have received over and above the internationally traded milk price is likely to continue to reduce. So farmers will need to focus on what they can do on farm to produce milk at a lower cost of production if they're going to survive and thrive. And for Australia, Argentina, and Uruguay, their milk prices have become increasingly competitive with all other countries. So this cannot explain any of their loss in comparative profitability. So how has pasture harvest influenced the changing fortunes of the countries in the study? Well, although you can see how impressive the South Africans have been in increasing pasture harvest through to around 2012, New Zealand's pasture harvest looks relatively unchanged over the 17-year period. And remember, it is in this highlighted period when Australia, Argentina, and Uruguay had higher levels of profitability than New Zealand, even though the levels of pasture harvest were much lower. Once trend lines are added, the changes in pasture harvest over this period are clearer. New Zealand in black has not improved its position compared to any of the other countries over this period, and yet it has gradually improved its level of profitability. I've added Tasmania, the southernmost Australian state, to this graph in light green, and Tasmania, along with the rest of Australia, have made more progress in improving pasture harvest than New Zealand, and yet lost profitability and competitiveness compared to New Zealand, as have Argentina and Uruguay. So if the level of pasture harvest doesn't explain any of the loss in profitability, what does? This graph plots changes in pasture as a percent of the total diet. This is defined as the percent of energy provided from pasture that is harvested on the effective dairy area as a percentage of the total annual energy requirements of the cows. New Zealand stands out with its very high percent of pasture in the diet. Once trend lines are included, it is evident that New Zealand has changed its production system little over the 17-year period, with pasture continuing to comprise over 75% of the diet. I've also added Tasmania in light green to this graph. When the table of the 17-year change in percent pasture in the diet is added, it is further evident how little New Zealand has changed. All four of the other countries have large decreases in pasture as a percent of the diet, with Australia and Argentina having the largest decreases. And it is Argentina and Australia where the steepest increases in cost of production and loss of profitability have occurred. These changes have coincided with significant increases in the amount of concentrate fed per cow and the continuing breeding of large US-type cows. Tasmania is the Australian state with easily the smallest decrease in pasture as a percent of the diet, and it is the one state with the highest level of profitability and the only one that has had consistent growth in milk production. So now let's look at the trends for cost of production, arguably the most important single measure outside return on capital for dairy businesses to monitor. Why? Because maintaining a low cost of production that is competitive with other export-focused countries is essential, especially as the world has become more interconnected. Equally, for domestic-focused dairy industries that are exposed to imported dairy products, it is essential that they can compete with these products on price. The table outlines how cost of production is calculated, with livestock revenue and any other non-milk revenue being deducted from total operating expenses. You can see in this graph that Australia, Argentina, and Uruguay all had similar or lower cost of production than New Zealand in the early period, with all three countries moving to having a much higher cost of production than New Zealand in the later period. The United States, in red, has a substantially higher cost of production throughout the entire period, which might make some of you wonder why so many farmers in pasture-based countries have been adopting US-type production systems. Once trend lines are added, it is clear how each country has been progressing. To further highlight these comparisons, I've added the table with year-on-year increases in cost of production for the 6 countries. New Zealand, South Africa, and the US are the top performers, with all 3 of the other countries having much higher increases in cost of production. This graph has operating profit margin on the vertical axis. Although there was a lot of volatility in this ratio, New Zealand has progressively moved to being in the strongest position, with South Africa arguably in the next strongest position in recent years. All 4 of the other countries, including the US, have lower operating profit margins, with Australia dropping to the bottom of the pack as time progresses, and both Argentina and Uruguay progressively losing ground against most of the other countries. This is the same operating profit margin graph with trend lines. This again highlights how New Zealand, South Africa, and the US have been maintaining or increasing profit margin, while the other 3 countries have been declining. It's important to note the low profit margin for the US, with this being a characteristic of all feedlot production systems. These systems are based on high volumes of milk being produced per cow, often 9,000 to 11,000 litres per cow, with this milk being produced at a comparatively low profit margin. This can still result in high levels of profitability when commodity prices run in the dairy farmer's favour, and can equally result in periods of large losses when commodity prices are unfavourable. However, feedlot or TMR systems could never be described as having financial resilience, given how just a small change in milk price or in other commodity prices can result in financial losses. Now I'd like to move to defining what the essential ratios are that dairy farmers should be measuring and monitoring. My paper on this subject analysed a large, comparatively unique, unbiased Australian dataset from a single year. This dataset included a wide range of production systems and environments across southern Australia. Though correlations or associations between two factors can be confirmed through statistical analysis, a correlation does not prove a causal link. Causation is more difficult to prove as it requires further evidence. An argument needs to be constructed to determine the link. Correlations in dairying are most often multifactorial, so associations between two variables need to be considered carefully for other explanations, or there is a risk of drawing the wrong inference. There is another important point to make in regards to this. Significant causal relationships don't reverse when trading conditions change. What will occur is that the trends will flatten or steepen and the tipping points will move. Similarly, a causal relationship does not change across years and it will not change between regions or between countries. What does change is how the relationship is expressed. That is, how the slope of the curve and the tipping point might change, with this depending on key commodity prices and the cost and potential quantity of pasture that can be grown. There would not be time to fully describe all the key relationships that relate to profit, so I'm going to work through this summary table with you. I've split these key ratios into primary ratios on the left and secondary or proxy ratios on the right. The primary ratios could be considered core to fully describing different aspects of a dairy business. So these are the ratios that ideally everyone should be monitoring. The secondary or proxy ratios describe a similar aspect of the business to the ratios listed to their left. All these ratios can be used for comparative analysis between farms. There are other important ratios such as return on equity or equity percentage that are specific to the individual business and not included in this presentation. All of the R-squared values are listed in the highlighted columns, with these confirming the proportion of the variation in profitability as defined by return on capital that can be explained by that factor. The R-squared value for farm data is unlikely to be very high, but even within a region, there are farms with different land capability, management capability, rainfall, stocking rate, and production system. This results in so many factors contributing to profit that it's difficult to single out just one factor as the cause. However, a low R-squared value does not mean that a relationship is not statistically significant or that it is not important to the level of profit on a farm or for the competitiveness of a dairy industry. The left-hand column of R-squared values for the primary ratios are ranked from highest to lowest. All of the p-values are listed in the highlighted columns, with these detailing the significance of the relationship. For an association between two variables to be considered statistically significant, typically a p-value of less than 0.05 is used as a threshold. That is, there is less than a 5% chance that the association has occurred due to random variation. The great majority of ratios that I will present have a p-value of less than 0.001, which means there was less than one chance in 1,000. This association has occurred by chance. So all the trends being described are strong. Return on capital is the ratio that defines profit, with this being the return on the value of all assets employed in the business. Profit ratios must reference capital, although profit per hectare and profit per cow only reference a portion of capital, namely the land or the cows. Although these two ratios could be described as proxies for profit, each has substantial weaknesses. Profit per hectare depends hugely on the productivity of the land, though the profit per hectare required to get, say, a 5% return on capital on highly productive or irrigated land is very different to what would be required on dry land if this dry land has half the potential pasture harvest of the more productive land. Similarly, the size or capacity of the cows and the total value of farm assets being carried per cow will determine the profit per cow required to attain a specific return on capital. Profit margin ratios are particularly important for quantifying risk and describing how resilient a business is to changes in milk price, supplement price, or climatic conditions. Operating profit margin is the more complete measure, as it assesses the margin on every dollar earned, as opposed to just the revenue from milk with profit per litre. Cost of production per litre and total expenses per litre are both excellent total cost measures. Cost of production is considered a more complete measure, as it includes revenue from livestock and other non-milk dairy sales, which offset the expenses associated with these non-milk sales, resulting in a more correct cost of production for milk. This methodology allows cost of production to be directly compared to milk price, with the difference being the profit margin prior to debt servicing or other investments. Pasture harvest has the highest correlation to profit compared to all other ratios, and by a wide margin, apart from partial profit and total cost ratios. The next highest correlating ratio to profit is pasture cost per tonne dry matter. And given how fundamental pasture is to dairy farm profitability, this second pasture-related ratio should be included as a primary ratio. This mix of a physical pasture measure and a financial measure ensures these two ratios provide different insights into pasture performance. Milk price is a primary ratio, but this needs to be calculated on the basis of energy-corrected milk to have this level of relevance. Milk production per hectare and stocking rate effectively describe a similar impact. As I'll demonstrate shortly, milk production per cow within this data set does not explain any of the variation in profit. So all of the correlation of milk production per hectare with profit is driven by stocking rate. Supplement cost per litre, which includes concentrates and forages such as hay and silage, and total feed cost per litre, which also includes pasture, have similar correlations with profit. For pasture-based farms, there should already be a couple of ratios being used to monitor pasture production and cost, so it'd be logical to use supplement cost per litre to focus on supplements. This core per cow cost ratio was developed by my software company, Red Sky, so that a group of costs related to the cows that do not include supplements or people, which require their own targeted ratios, could be monitored. This table outlines the range and proportion of each cost centre included in this ratio. Effectively, this provides an opportunity to monitor specific cow cost codes. There are a group of labour ratios that farmers can be encouraged to monitor in different countries, and hopefully these can now be ranked appropriately. The largest proportion of staff time in a dairy business is associated with cows, including milking, feeding, and caring for these cows. So the ratios with the strongest causal link to profit will be those referencing cows. The primary ratio is labour cost per cow, with the labour cost including a full cost of management. Labour cost per cow and per litre are similar ratios in structure. So if a second labour ratio would be monitored, then it should be selected from one of these other two ratios. Again, the causal link with cows and profit would mean that cows per full-time staff equivalent would be preferred. There is another weakness with the litre ratios, in that these need to be calculated based on energy-corrected milk to have this level of relevance. This core per hectare cost per tonne dry matter of pasture harvest ratio was also developed by Red Sky, so that a group of costs related to the land area that do not include supplements or people could be monitored. This table outlines the range and proportion of each cost centre included in the calculation. This ratio is the most relevant for determining the performance of a dairy business and controlling farm area or hectare costs, which, to be relevant and have significance, needs to reference the amount of pasture harvested per hectare. Pasture as a percent of the cow's diet is the ratio that describes the farm production system being implemented. The relevance of this ratio will be described in depth later in this presentation. Pasture consumed per cow is a similar ratio in most regards, though would be a secondary ratio. You may have noticed that milk production per cow is neither a primary nor a secondary or proxy ratio. The reason for this will become clear shortly. So I'd now like to look at the wider impacts of increasing pasture harvest. This graph outlines the impact of pasture harvest on profit or return on capital. The trend is strong, with increasing pasture harvest contributing to an increase in profit. I'm going to run you through quite a number of graphs and build them into groups of 4. So this relationship of pasture harvest return on capital is similar to the impact on profit per hectare and profit per cow. This graph outlines the impact of pasture harvest on cost of production per litre. The trend is strong, with increasing pasture harvest contributing to a decrease in cost of production. So these are the first 4 graphs. What else does pasture harvest influence? This graph moves pasture harvest to the vertical axis and has stocking rate in cows per hectare on the horizontal axis. The trend is very strong, with increasing stocking rate significantly contributing to an increase in pasture harvest. Now I'm going to add graphs of 3 more cost factors that all decrease as pasture harvest increases. This includes core per hectare cost per tonne dry matter of pasture, pasture cost per tonne dry matter, and supplement cost per litre. So all of these trends are consistent and strong. What else does pasture harvest influence? There are 2 more cost factors that decrease as pasture harvest increases, with these being labour cost per cow and core per cow cost. This final graph outlines the impact of pasture consumed per cow on pasture harvest, with increasing pasture consumption per cow contributing to an increase in pasture harvest. This table summarises the primary impacts of increasing pasture harvest on the performance of a pasture-based dairy business, which include lower pasture cost per tonne dry matter, lower core per hectare cost per tonne dry matter of pasture, lower supplement cost per litre, lower labour cost per cow, and lower core cost per cow. Changes in these ratios combine to significantly lower the cost of production. Increasing stocking rate plays a significant role in increasing pasture harvest, which underpins the requirement to have sufficient cows grazing per hectare to optimise pasture harvest. Now I'd like to review the wider impacts of increasing milk production per cow. This graph outlines the impact of milk production per cow on profit or return on capital. The relationship is significant and confirms that milk production per cow does not positively correlate with profit, something that many pasture-based farmers struggle to come to terms with. However, very low or very high levels of milk production per cow are likely to reduce profit. So this is the relationship of milk production per cow to return on capital, and is similar to the impact on profit per hectare and profit per cow. This graph outlines the impact of milk production per cow on cost of production per litre. The trend confirms milk production per cow has no effective impact on cost of production and explains none of the variance in cost of production. So these are the first 4 graphs. What else does milk production per cow influence? Now I'm going to add graphs of 4 more cost factors that all increase as milk production per cow increases. This includes core per cow cost, supplement cost per litre, total feed cost per litre, including pasture cost, and labour cost per cow. So the impact of increasing milk production per cow is substantial on increasing multiple cost centres. What else does milk production per cow influence? There are 2 more cost factors that increase as milk production per cow increases. These are pasture cost per tonne dry matter and core per hectare cost per tonne dry matter of pasture. So this table summarises the primary impacts of increasing milk production per cow on the performance of a pasture-based dairy business, which include higher supplement and total feed cost per litre, higher core per cow cost, higher labour cost per cow, higher pasture cost per tonne dry matter, and higher core per hectare cost per tonne dry matter of pasture. The result is that increasing milk production per cow has no significant impact on profitability, other than at very low or very high levels of milk production per cow, where there is a negative impact on profit. This is not the same for a feedlot or TMR production system, where milk production per cow will correlate with profit. This underpins the important structural difference between feedlot and pasture-based farms. Feedlot farms are similar to the great majority of commercial businesses, where the primary sale product, milk in this case, is the primary driver of profit. However, with pasture-based farms, it is pasture production that is the primary driver of profit, with the sale product, milk, being a byproduct from the pasture production process. Now I'd like to review the wider impacts of increasing pasture as a percent of the cow's diet. This graph outlines the impact of diet pasture percent on profit or return on capital. The trend is relatively strong, and the relationship can be described as one where as pasture as a percent of the cow's diet decreases, there is initially little variation or impact on profit, although a negative impact becomes increasingly evident as the percent of pasture decreases. So this relationship of diet pasture percent to return on capital is similar to the impact on profit per hectare and profit per cow, with decreasing diet pasture percent having an increasingly negative impact on profitability. This graph outlines the impact of diet pasture percent on cost of production per litre. The trend is strong, with increasing diet pasture percent contributing to a decrease in cost of production. So these are the first four graphs. What else does diet pasture percent influence? This graph outlines the strong association between increasing diet pasture percent and increasing pasture consumed per cow. This graph outlines the impact of diet pasture percent on pasture harvest, which is a particularly important relationship to understand. The trend is strong, with increasing diet pasture percent contributing to an increase in pasture harvest. In addition to this, supplement cost per litre and total feed cost per litre, including pasture cost, decrease substantially as diet pasture percent increases. All of the trends are consistent and strong. What else does diet pasture percent influence? Now I'm going to add graphs of four more cost factors that all decrease as diet pasture percent increases. This includes core per hectare cost per tonne dry matter, pasture cost per tonne dry matter, core per cow cost, and labour cost per cow. Again, the trends are consistent and strong, and still there is more. Although these final two graphs highlight the known negative impacts of increasing pasture as a percent of the cow's diet. Firstly, this graph outlines the impact of diet pasture percent on total dry matter consumed per cow, and now the impact on milk production per cow. The trends are understandably similar, with increasing diet pasture percent contributing to a decrease in total intake and milk production per cow. So this table summarises the primary impact of increasing pasture as a percent of the diet, which include lower supplement and total feed cost per litre, lower core per hectare cost per tonne dry matter of pasture, lower pasture cost per tonne dry matter, lower core per cow cost, lower labour cost per cow, and importantly, higher pasture harvest. Changes in these ratios combine to significantly decrease the cost of production. Additional impacts of increasing diet pasture percent include an associated increase in pasture consumed per cow, and a decrease in both total consumed per cow and milk production per cow. However, the impact of producing less milk per cow is more than compensated for by the lower costs and higher pasture harvest, resulting in an increase in the level of profit, with the rate of increase reducing as pasture as a percent of the diet increases. Now I'd like to circle back to confirming the factors that would define business resilience. That is, what characterises a business with a high profit margin, a business that can withstand low milk prices, high supplement prices, or poor weather that reduces pasture harvest and crop yields. How does increasing pasture harvest impact on profit margin? Well, it impacts in a significant and very positive way. How about increasing milk production per cow? Well, increasing milk production per cow doesn't help in any way. In fact, lifting milk production per cow up to high levels will most probably reduce profit margin and undermine business resilience. How about increasing pasture as a percent of the cow's diet? Well, in a similar way to increasing pasture harvest, increasing pasture as a percent of the diet impacts profit margin in a significant and very positive way, unless the farm already has a very high percent of pasture in the diet. Now I'd like to review the impact of climatic variability and the potential warming of the planet. What is the logical response to climate variability, and in particular to lower pasture and crop yields? Well, hopefully this is now clear to you. Increase pasture as a percent of the cow's diet. Why? Because this will increase profit margin, which will ensure the production system and the farming business is more resilient. As this graph highlighted, increasing diet pasture percent impacts profit margin in a significant and very positive way. This principle can be further highlighted by a South African study that I recently completed. The study involved modelling the impact of increasing pasture percent in the diet for an average farm, starting with 41% pasture and then increasing this in 4 equal 4% increments to a maximum of 57% pasture in the diet. And this was the result of the study. As the models moved from the 41% pasture through to 57% pasture in the diet, profit per hectare increases from 3.4 US cents to 5.3 cents per litre. This is almost a 60% increase in profit margin, meaning an average dairy farm business can accommodate a much larger change in milk price, supplement price, pasture harvest, or other challenge before profit becomes severely constrained. Before we can claim that these improvements are unconditionally persuasive, we should review how sensitive these results are to variability in climatic conditions, including the impact on pasture harvest, silage and crop yields, silage cost and the cost of other forages, and concentrate cost. First, I'd like to outline the basis for this climatic sensitivity analysis. This includes variation around the average or base pasture harvest, with this increasing or decreasing up to 1 tonne dry matter per hectare from a base level of 11.3 tonne dry matter. Maize silage yields were also sensitised around a 14 tonne dry matter per hectare yield, with this increasing or decreasing up to 1 tonne dry matter per hectare. Maize silage is the predominant forage used in South Africa, with a majority of dairy farmers producing most of this themselves. The cost assumption was that the total cost of these crops, including planting, growing and harvesting, would be unchanged, so the effective price per tonne for this silage increases or decreases on the basis of yield. Concentrate price was also sensitised around $253 per tonne, or around 230 euros per tonne, with this increasing or decreasing up to 12 euros per tonne. This assumption was primarily based on the impact of more or less pasture availability, changing the requirement in the concentrate mix for added protein and potentially some other additives. So what were the results? This graph has return on capital on the vertical axis, with the models on the horizontal axis moving from 41% pasture on the left to 57% on the right. You can see that profitability increases in all scenarios as diet pasture percent increases, regardless of climate variation. And the increase in profitability appears to be similar, regardless of whether the climate is advantageous or poor. This graph has profit per hectare on the vertical axis, which looks very similar in shape to the return on capital graph. When just the change in performance is graphed, then in this return on capital graph, the range of improvements are between 1.3 and 1.8%. In the second profit per hectare graph, the range of improvements are between $210 and $330 per hectare. The increases in both these ratios are consistent, and as you can see, the biggest improvements in profitability are in years of poor climate. This further highlights how increasing diet pasture percent increases the resilience of dairy farm performance. When just the change in cost of production is plotted on the graph, and the change in profit margin on the second graph, then it is clear that the benefits gained from increasing diet pasture percent on lowering the cost of production and increasing profit margin are evident across all climatic conditions. So if the improvements in farm profitability and business resilience are so significant, why has there been what might be described as a slippage in production systems? Why have UK and other farmers progressively increased the amount of supplement fed to their cows and reduced diet pasture percent? It is a good question. This slippage is comparatively widespread, as this graph of diet pasture percent highlighted. New Zealand appears to be the standout, or holdout, from adding a lot more concentrate and supplement to the cow's diet and focusing on increasing milk production per cow. But they are not the only holdout. Ireland is another excellent example of an industry that has been successful in focusing more on production systems that deliver a lower cost of production. Tasmania may have lost ground compared to New Zealand, but has done very well compared to the other states in Australia. And of course, there are many farmers in other countries that have successfully resisted the trend to feeding more supplements. So what is behind the slippage? Firstly, we should accept that pasture-based dairying is a complex and relatively unique business, where pasture is the main profit driver, despite milk being the saleable product. This results in almost all economic relationships being counterintuitive, as they appear to be contradictory to the biological ones. For instance, feeding more concentrate will often result in the cow being more efficient, but the financial impact will most likely be neutral or potentially negative. Then you add what Professor Bill Malcolm describes as a plague of economic illiteracy, including amongst some service providers and industry organisations. I'm saying these are Bill's words, who's Professor of Agricultural Economics at the University of Melbourne. Though maybe this assessment should not be such a surprise, given most people working in agriculture are trained in science or biology, as opposed to economics. I believe you can overlay on this a tendency for many farmers to be influenced by the pride of producing more milk per cow, with farmers being further influenced by the higher milk prices offered by milk processors for flatter milk supply curves. And then, given the low economic literacy, farmers can often be influenced by salesmen and advisors using simplistic and inaccurate gross margins to promote a product or a course of action. On top of all of this, dairy farming is a biological multi-year production system, which when added to climatic variability, results in profitability trends for an individual farm taking 5 to 10 years or more to emerge. And when an individual farmer or an entire industry, in the case of Australia, realise they are off track, they can find their cow genotype as determining what production system they can run, rather than their choice of production system determining their cow genotype. And a farmer can then find it difficult and even scary to consider unwinding their production system, given this might mean targeting a reduction in milk production and hence a reduction in gross farm revenue. However, to summarise my presentation, to maximise profitability and build resilience, farmers need to 1. Maximise pasture harvest, 2. Optimise the farm production system by targeting a high percent of pasture in the cow's diet, 3. Optimise the execution of farm management in pursuing whatever operational plan has been set for the year. Although I don't have data to present to support this particular point, I'd break it down into 3 factors, including aspiring to have all physical activities characterised as being the right action, first time and on time. The second factor would be to minimise every cost centre wherever possible within the business. And the third factor would be to minimise depreciation, not just by having vehicles and machinery last for many years, but also critically to minimise herd depreciation by having cows that can survive in the herd for many years and then keeping these cows in the herd for many years. And remember, focusing on all of these factors will increase business resilience by increasing profit margin. I don't have any doubt that UK farmers and the dairy industry as a whole could compete internationally and grow significantly in size, though this will almost certainly require a change in the production system on many farms to one that includes a significantly higher percent of pasture in the diet. Thank you.
Thank you, David. A very interesting presentation there. I must say your argument around building resilience into the business by increasing pasture production or pasture harvest seemed a little bit counterintuitive at first, but once you got the argument through, it made perfect sense. We've got a few questions here, so if everybody wants to start sending through the questions, we'll start moving through them. If we don't have time to get through them all, we will be putting them on our website, which we'll be putting up a link to via our Facebook page. The first question I have here for you, David, is I just thought it'd be good to touch on this, to allow everybody watching to compare their operations. What exactly are you including when you say pasture?
Okay, look, what's included is the pasture grown and consumed on the milking area. So it's solely to do with the milking area, including any of this pasture that's conserved as silage or hay. So the milking area is the area where the milking cows graze during the year. So it's a specific area, and also included any green feed crops grown on the milking area that are grazed in situ. There are two reasons for including this. Firstly, they're usually part of a pasture renewal program, so part of the pasture production profile, and secondly, the yield of actually consumed green feed crops grazed in situ are almost impossible to independently assess. So that's the basis.
Very good. That will hopefully help people to compare your figures then. So the next question is, what should people be looking at when making breeding decisions, given the data shows that solely increasing milk production does not lead to increased profitability?
Okay, well, look, what each farmer needs is a cow that thrives under the production system that they have decided to run. So it's very specific to each production system or each farm. And what do I mean by a cow that's going to thrive? Well, a cow that is relatively efficiently converting whatever mix of feeds the farmer has chosen to offer the cows into milk, while staying healthy and reliably getting back in calf each year. The key is to breed a genotype of cow that fits the production system. And this cow is a very different size and shape to fit, say, a 90, 100% pasture diet in New Zealand compared to 100% TMR or feedlot diet in the US. Or say a 40% pasture diet compared to a 70% pasture diet in the UK. Critically, a farmer should design the production system first before determining their breeding decisions, or they can get into the same position as I've suggested that the majority of Australian dairy farmers have got themselves into, where they've got a cow that needs to be fed a heap of concentrate and struggles to get in calf within 12 months. So even if these farmers wanted to move back to a lower cost of production system with a higher profit margin, their cows won't allow them effectively to do this now.
I know, very good. If we continue having dry spells like we've seen in the summer of 2018 and spring of 2020, where there was a significant stoppage in grass growth, do we start looking at restocking or stocking rates?
The answer is probably a provisional yes. So important to differentiate though between whether you are saying, or the farmers feel that variability is changing, or whether you're saying on average with that variability the expected amount of pasture produced or harvested has gone down. So if a farmer forms the opinion that the average, not the extremes, but the average pasture yield has reduced by, say, 5%, then potentially stocking rate should be adjusted pro rata. But just remember, this presumes that the farmer has no clear opportunities to improve pasture harvest via improved management. They're already optimizing that, and that prior to this changing climate, the farmer already had the optimum production system in operation. My expectation would be that most UK farmers are like almost farmers in many other places, are likely to have opportunities to refine their production system and potentially increase pasture harvest, and that these opportunities in reality may be more significant than any impact from medium-term climate change. And another thing to remember, if it's just the extremes you're concerned about, so we're saying, look, on average it's not so different, but the extremes, yes, definitely we're having some drier years. Are they being offset by some wetter ones? I'm not sure. So the average yields are not significantly changing, but there is more likelihood of dry spells. Then this would simply mean that the production system should be biased towards higher percent of pasture in the diet, as you could see in that study I did for South African production systems. So that the cost of production, so in that case, if you're saying I'm challenged by climate, bigger climate swings, it would be the same as saying I'm challenged by bigger milk price swings or bigger swings in concentrate or other core cost of the business. Then what you're after is a production system with a lower cost and a higher profit margin, so that when those things happen, you don't feel it as much as if you've got a lower cost margin and which comes from the higher concentrate or supplement percentage of the diet.
All right, very good. With the UK being similar to the South Island of New Zealand in climatic situations and not like that of Australia and South Africa, what percentage in confidence do you have that the data applies to the UK temperate climate?
Okay, I'm saying this with a bit of a smile, as you can see, but basically absolute confidence that it applies to the UK. So that any reputable studies of these principles, including by people that some of many of you will know, people such as John Roach or Mark Neal out of New Zealand and Dairy NZ, they've produced similar results to what I've outlined to you in the presentation, what was in my published papers last year. As I tried to describe in my presentation, the relationships are universal within pasture-based farming, which is pretty consistent with any economic principles outside farming as well. The principle doesn't change, how it's expressed has changed. So it's all the only thing that is in question and is valid is for each region, the slope of the curves and the tipping points can change. So for instance, with pasture as a percent of the diet, what I can't say with confidence is where the curve flattens for the UK. With the South Island of New Zealand, I believe it's likely to be over 85% of pasture in the diet. But for the UK, with higher milk prices than they get in New Zealand, and potentially, if anything, lower concentrate prices, I'd be presuming that maybe where it's over 85% in New Zealand, it might be between 70 and 80%, though I actually can't be sure of that.
Oh no, that's good. That sort of segues quite well into the next question I have here. Has your research shown that there is an optimum level of pasture in the diet? And if so, what would you estimate it to be for the UK and Ireland, given their ability to grow 12 ME grass throughout the grazing season, with growth and utilisation upwards of 12 tonnes of dry matter per hectare?
Okay. That's a good question again. There is an optimum range rather than a specific level of the goal percentage or optimum percentage of pasture in the diet, which you might imagine, given it's a curvilinear nature of a relationship. So maybe when we're thinking of optimums, think of an optimum range of say 5 or even 10%. Then this range varies depending on average commodity prices. So a farmer that supplies UK farmer that supplies a processor that regularly pays a higher milk price than other processors, or a farmer who has a source of feed that is lower cost than for most other farmers, or for instance, a farmer that harvests more pasture per hectare, which effectively results in the pasture cost being lower for those farmers. Normally it will be. Or simply, if it's a farmer who is just very, very good at controlling costs and has a lower cost structure than others. So that group will have an optimum profit point with less pasture in the diet than for other farmers. So less pasture there. So if, and I say it's a big if, UK farmers could optimize their production between 70 and 80% pasture in the diet, which I'm not confident I'm right with, but let's use that. Then the best farmers, the most competent and or those who are exposed to the best pricing. So those will optimize profitability closer to 70% pasture in the diet. The average farmers in the UK would be maybe around 75%, and the below average farmers should be targeting something like 80% in the diet. So that's the best I can answer the question for now, anyway.
No, that's good. It must be, can't be easy to answer that one, given there's a wide spectrum of grass growth areas and utilisation and that which you'd be having to take into account.
I'd also, the easiest way, which I've done with, obviously with Australia, is to have access to a large data set. I had the same for South Africa, where I've done a lot of work, and although there was in this case, more, as is often the risk, a more significant bias in that data, but again, you could do that. It was really, it's not, I'll give an opinion, but I'd rather base it on absolute evidence. And that's why I'm actually really confident about the New Zealand data, because people I know really well there who've got access to largish and relatively unbiased data, and that's good. And I understand, I'm personally hoping to do a bit of work with some of those New Zealanders, as well as some people out of Ireland, Lawrence Shalou, and where we would do it. So if I got access to a large set of relatively unbiased UK data, I'd be thrilled to analyse it in the same way that I've done the other stuff.
No, not a problem. So the next question we have here is, should we embrace technology likes of collars and etc. for heat detection to reduce empty rates and labour demands?
So again, a good question. I might surprise people by saying, firstly, there's a very low correlation. There's not a lot of work being done, but nor has anyone been able to prove any correlation between most technology and profitability. And you can imagine that people would love to be able to do that and say, the people selling collars, have they got any real data? It's difficult to often get good data to even analyse, but not being able to show it. So it's one of the characteristics of pasture-based farming, is that technology doesn't actually provide a lot of help. And I've had access to significant databases, so real performance for farmers from multiple countries for years and years, and had the privilege of working with many of them. And you soon recognise that some of the most profitable farmers use no technology at all. In fact, some of the best farmers I've come across don't know what a kilogram of dry matter is, but they sure as hell know when their cows have gone into the right pasture and come out at exactly the right level, and they do it day after day, keep their costs down, and have a production system that's there. So although I love technology myself, have been involved in software and a range of things, I know that it doesn't tend to provide a lot of benefit. And what I see is the key things to get right require the operator of the farm to have a really well-trained pair of eyes, a pair of ears, and a nose, basically, because you're observing how cows are being integrated with pasture every day at just the right level, and any supplement and other stuff, and keeping them healthy, which requires the operator to be very close to that physically themselves and observing, and is why you also see when farms get large that the performance tends to drop off, because the operator gets pulled back away. So it's a bit it's a rather lengthy answer. Apologise for that, but it means the first thing is I'm thinking there's no evidence that technology helps a lot, and one of the risks is when a farmer has a lot of results of things coming up on a computer screen. I always say the biggest risk is they might sit in front of the computer screen and look at the data rather than get back out in the paddock and into the dairy and do a range of things. So, and if you've got, then maybe I could have just made a very short answer, and I'd say if you've got the right cow, the right production system, you've developed the right production system, and then you have the right genotype of cow, there shouldn't be a need. So there'll be, I'm not saying farmers shouldn't use it, because it can be a help, but it tends to be most important once you've got a problem that you'd love not to have, which is the cow under your system thrives, and that involves under your system it readily gets in calf.
That's thank you. You've answered that fairly well there. The next question we have here is going back to the variance in pasture grown due to climatic conditions. So it says, we're seeing greater variance in the amount of pasture grown each year. What strategy should we put in place to combat this variance? So is any difference from what you talked about earlier on there?
No. Look, I will keep this one answer short, which is it's an interesting concept, and it's built around, I've hopefully already said, but I want to re-emphasize, which is, we, for years and years, in many countries, people have said, look, the key to profitability is the farmer, the operator. If they're good, it doesn't matter what system they run, they're going to be profitable. I'm telling you, provably, that's nonsense. But it's a nonsense that's put around in countries, including often even in countries like New Zealand, which are more focused on getting things so right in many areas. Because that's really what I've really tried to show, and which the evidence confirms, but which for so long has been less clear, is that you absolutely want a good operator, but the operator wants to have designed the right production system. You get both right, and those are the guys in the top 5% reliably year after year in profitability. You have the wrong system, and the wrong system, I'm saying, in pasture-based farming is when pasture is a low percentage of the diet. You can have very good people still being profitable. They just are not going to ever reliably compete with the other ones. They won't. When milk price is very high, they will more than compete. They might even beat many of those, but at average they won't, and at poor they tend to be a lot worse off. This has been a little bit longer answer. So what's interesting is, which I helped me when I did the study for South Africa on top of the other stuff that I published last year, is what becomes self-evident, which is you want to handle this greater variance, err on the side of more pasture in the diet, not less. And it's one more of those counterintuitive type ideas. You'd think, hold on, if I'm responding, surely it'd be better to have more supplement, more concentrate reliably the diet. And this is exactly what we're talking about, why it's so hard. Well, the thing I've said for decades now is dairy farming is the most complex business on the planet. And most people who take it up didn't decide they wanted to be challenged by the most complex business on the planet. It's linked to this: pasture is the driver, milk is the product. Almost every business on the planet is different, and whatever you produce is your primary profit driver. But similarly, counterintuitively, it's actually increased pasture percentage of the diet if you think you've got more variability in pasture, basically because you increase your profit margin, you can just handle the difference. So sorry, it did take a bit longer than I thought, but anyway.
No, that's fine. So the next question here is, you touched based about Australia largely having the wrong cow. Have you factored in the large waste of stock in Australia, with some of the farms that use the larger cows having empty rates over 20%, which is requiring larger replacement numbers? Also, those same types of farms using more sex semen and pushing their days in milk out.
So again, I apologise because I'm not sure exactly what the question's getting up. So I'll make a couple of comments. One is the data set that I used for that paper was 2006 data. It was a year and around that time when I was paid to gather a lot of data on behalf of state governments and a range of people that allowed it to be this wide range of systems. So it was before Australia had gone nearly as far wrong. So as far as firstly that particular data, it's not an issue, and therefore what I've drawn from it, although remember I'm trying to make really clear it wouldn't matter, these things become evident. The South African data was for four or so years, very recent years, and the same principles that will be evident regardless, as long as it's a genuinely spread and unbiased set of data. So it's not a factor. The question doesn't question whether the data there, but it is an interesting question from the point of view that the question have factored in. That is true. That's a factor for those who have got a cow that doesn't fit their system, or that is dragging their system in a particular angle. So now there are a lot more farmers, 14 years later in Australia, even more farmers who have been breeding the type of cow with more US genetics that just require more feeding. But again, as long as you're doing a study of a broad data set, there's lots of farmers in Australia, a lot more then, and there are still actually a lot, especially in Tassie and parts of southern Australia, who have got the right system. It's just the proportion is reducing, and the overall numbers have unfortunately swung in the wrong direction. I hope that answers the question reasonably.
Yeah, well, yeah, answered as best as you can, I think. So why do higher yields decrease operating profit margin?
It's because, and to say that the papers are obviously, the published papers are online, and for anyone interested, I'm hoping, although there's quite a bit of data in them, both the papers are published, I'm told anyway, are a lot more readable and easier to follow than many published, especially scientific as opposed to economic papers. So I'd really encourage people who've got an interest, key determinants of profit in particular, would help in great detail understand the bits and pieces that I've tried to summarize, and I know throw graph after graph. But what that section in the paper and what I tried to put in my presentation is really saying is that the group of costs that go up, and they go up at a similar, so to get higher yields, your costs go up at a roughly similar rate to the gain in revenue you get from the extra milk. And that paper, and I tried to put in the presentation, say exactly what happens. And if I was trying to bring it back to a level, it might be overly simplistic, but it is that as you try and push more and more milk out of cows in a pasture or in a feedlot, but I'd say feedlot's a different business. Structurally, it's a bit like, I'd rather people think of feedlot or 100% TMR as an entirely different business, that as different as beef farming is to dairy farming. And that's another pain in the backside, because people don't think of it that way, but it has different profit drivers. So pasture-based, what happens is you're trying to run, think of it as a car race, it's a difference between running these high-producing cows are like a racing Ferrari. And it's the difference to the lower yielding and appropriately genotyped cow is like racing not even a Ford Mustang, just a Ford Falcon or something like that. And if you've ever seen those two things done, the Ferrari has 20 people around the vehicle trying to keep it on the road and 50 in the garage, and the Ford Falcon has about 5 around it and 5 in the garage. And that is what happens with these cows. To get that milk production right every day, you've got to attend to it more. So there's people around it, so labour productivity is down. For instance, in a feedlot dairy, you have roughly half the labour productivity of its equivalent pasture-based dairy. So, if in Australia or New Zealand, not in New Zealand, but Australia, or the thing, you might have a reasonably efficient pasture-based farm with 150 cows per person, and a same feedlot would be about 75. And every other thing, animal health, breeding goes up, every cost goes up, and that's what my analysis of the data shows. And really what happens is, you can see in the data, you just don't get you don't get a benefit, you go nowhere, but you're spending a whole lot more money, and a range of other things are happening.
Yeah, I know, that's good, thank you. So as long as milk price remains as it is, do you accept that most farmers will do nothing about changing their system?
If I presume it's a UK question, I'm probably saying I hope not, because the UK and it's as an Australian, I'm not sure I want to use any sporting analogies at the moment, because we've been a bit crap in a lot of what we've been doing lately. But I make the point because the only gratification I can see in the data that UK farmers should take is at least those bloody Aussies are worse than you are. But you are the next worst in my data set. It's poor. So and it's really poor, in my view, for the overall industry, for its position. Apologies if I'm being a bit tough. Is really poor because, unlike you on average can probably produce 50% more pasture than an Australian farmer. our average is around 8. I don't know if that is fair, whether it is quite that much, but you produce more and it's higher quality. So the UK should be in my view, should be one of the powerhouses, and you're absolutely not. I don't think this is a surprise to you guys. So I'd be saying, look, it's just the opposite. I'd say there's a major opportunity that the far too high a proportion have not yet got the production system right, even close necessarily to maximising, minimising cost of production, maximising profit margin to get a good return on capital. So no, absolutely it should change. All I was saying about prices, I think that's going to really put some pressure on the UK. But like in South Africa, that every year that goes on, the gap between the premium paid for domestic producers or domestic focused countries to exporting countries changes, and with Brexit and wanting to trade more, it's just going to become greater. So sorry, no, I think I don't accept that.
No, fair enough. I'll miss the next question as we've sort of already answered it, and I don't think you'll be able to answer the question specifically around their level of grass growing. I can. Please ask.
I'll make it very short.
Yep. So this one is there an optimum level of yield of pasture consumed? We are at 17 tonnes of dry matter per hectare.
And of course, it will depend on the value on the land's potential. But there is an answer to that. And this one I am going to keep short: as much as possible. End of story. For any farm and any, as much as possible. It's a straight line increasing relationship without getting stupid and putting on so much nitrogen or something that you've been purely wasteful. Yep. So next question.
Yep. All right, no problem. Does increasing pasture and diet expose you to more dry weather as no grass, no feed? Is this because high pasture in the diet farm has made and makes a lot of money, so it can afford to buy and feed when it is dry?
So it's a good question, because it's getting to the root of these issues. So yes, so firstly, it's counterintuitive that, and the question appears to be getting to the nub of it, which is that if you run a higher percentage of pasture in the diet, the profit margin is higher. So it takes a much bigger change in weather to have the same impact. Again, I know it's a struggle sometimes, but it sounds a bit counterintuitive. It has a much bigger profit margin to handle a change than someone who's got a lower percentage of pasture and a higher supplement. And in fact, if you want to see it in a practical sense, the New Zealanders are a classic. They complain sometimes their weather's more variable and it's all around the place. How really valid these concerns are, I'm not sure myself. But when you've already got mostly pasture there and a really high profit margin compared, look at the New Zealanders at 30% very often. The other thing is, even when things are bad, especially in climates like New Zealand's or the UK's, that variability, please, it's quite funny for you guys to be worried about variability. Come to Australia a bit more and we'll show you. I mean, you don't even know what variability is, but when your total cost of feed is so small, and that goes up even by 30%, it has very little, or 50%, it has very little impact on the bottom line anyway, on a bottom line that is much greater. So I don't know if that's any help, but that's the basis of
it. Yep. Any correlation between high stocking rates at pasture and higher winter housing costs? So this is a very UK-driven question where we house cows over the winter time. So it's again an interesting question. Is the correlation between stocking rate and cost? There's certainly a relationship between the stocking rate has to be right, and that's as opposed to high. So you see the graphs
really highlight that there's a very strong relationship between stocking rate and pasture harvest, so that's good. But what you see in many countries, Australia, South Africa, is because stocking rate is linked to increasing pasture harvest, and in many farms it's been a key to increasing pasture harvest and increasing profitability. Farmers have kept going often. It's worked, so I'll put a few more on and I get more milk, and this appears to be working. Where do you stop? And it's a real problem for many farms. Once you overstock, so you have more stock than is required to optimize pasture harvest, obviously if you put on more animals, then you're decreasing pasture as a percentage of the diet. And as I've shown separately, then you've got an issue, and that's a serious issue, or I believe it will be in time in, say, South Africa, where they've been so successful initially at getting more pasture harvest. And obviously if the stocking rate goes up past that optimum, then more demand for feed, so that absolutely feeds directly into the question. Yes, suddenly you've pushed yourself in a position where you're overstocked. If you do that, you saw that graph, which I don't think's been published before, about pasture's percent of the diet goes down. Once it starts going really down, pasture harvest comes down as well, and then you're also additionally exposed, as we've talked about purchased feed and risk. And that's what the winter housing's about, is how do you then take, you aren't able to handle them outside, so you're almost pushed inside. So because we don't tend to do that in the jurisdictions, the housing, all the impacts of what you're describing as housing are absolutely evident in actually a whole bunch of the stuff I'm trying to present, and it's there. So the goal is to have no more cows than is required to optimize pasture harvest, and that for many farmers, and there'll be from huge numbers of farmers in the UK, if we go back to the other question, without doubt, because the percentage of pasture in the diet is comparatively low for what could be required to run highly functional cows and to maximize pasture harvest. And I spent many years incorrectly advising farmers that really, if you which I have to admit, it's a great thing of data, good data and evidence, is that no, it doesn't really matter if you're a bit overstocked, as long as you're really good with your management, and if you've got the supplements, you can make sure each grazing is right, so there's not an issue. Well, I've got to admit, I was bloody wrong, and clearly wrong in the evidence, and it is supported by lots of visible causal issues, and links into this question well.
Yep. All right. Well, time's pressing on, so we'll just try and get through a few more questions, and then we'll answer the rest via email and put them on our website. So I'll just try and get through probably more questions if we can. I think a couple of them here we might. Why is it that New Zealand's dairy farms are only making surplus profit 1 in 3 years?
So it depends. I'm laughing because I spent the best part of 40 years as a New Zealander. I'm now a vowed Australian, and used to love taking the mickey out of New Zealanders. And but if we talk about operating profit, so it's a genuine assessment of profit before interest. So it's actually a personal farm's decision about interest. So it's the key one. You're making a profit, and you can decide whether you want to borrow a heap and do a range of things. I'm laughing because bloody New Zealanders have been profitable every damn year, full stop, and normally highly profitable. That's their profit margin. On average, they keep 30 cents in each dollar. I reckon UK will be down at about 7 cents. Or now I'm talking in, that's fine. It doesn't matter what currency you're talking about. But I'm talking about New Zealand or Australian dollars roughly at the moment. They're highly profitable every year. Their milk price dropped to a level that almost no other country could survive, and most of their farmers were still profitable. So bugger it all. I dislike having to admit it, but they're hugely profitable. Of course, being Kiwis, they decided they had to spend their money, like most farmers, somewhere, and so they decided to borrow enormous amounts of money, pay far too much for land, and this is their serious issue. Not so much the debt, but the fact that their land, and this is in one of the papers, means that they have, if they look at their cost of production, including, if you include a cost of capital in that, which is a full, what they call an economic cost of production, they lose a lot of their benefit. So their issue is to do with paying too much for land, and linked to that, because they're so hugely profitable, being allowed and encouraged to borrow ridiculous sums of money, and that's what's put pressure on. And still, even with that, that statistic of 1 in 3 years is actually wrong. It's not correct. That's much higher than that. Sorry, but
yeah,
the next question.
I'll probably add on something there as well, that it's only been the last 12 years that New Zealand farmers have actually had to make a profit from a banking's perspective. Banks prior to 2008 were more than happy to lend money as long as the rate of land value was going up faster than the rate of debt.
Yeah, which is no excuse for their farmers then accepting the money. So I know we can blame banks, milk processors, but if we listen to them, either of those parties, and decide that they should tell us what we should do, we've got a big problem.
Yeah. So this is going back to the definition around your pasture. So are we defining pasture as homegrown forage or grazed forage?
Absolutely. It's not forage. It's well, again, if I use I believe the correct definition of forage, then in a dairy farm you've only got feeds, genuine feeds that are either concentrates or forages, and I make a distinction in all mine including how I analyse a farm, between what I call concentrate costs in my presentation, forage costs, meaning forage costs excluding pasture and pasture. Now, so are we defining? So I'm not defining pasture, and it might be semantics, but it is important to be clear that I'm saying it's not pasture as it's closest to homegrown pasture, not homegrown forage. Homegrown pasture, where homegrown is not even homegrown, because that will often include pasture grown on a support block, or pasture grown on a support block for young stock. So although it's relevant, the same principles are relevant to pasture on a support block. If you want to grow your young stock at a low cost, produce at a low cost in pasture, and the young stock's diet has to be high, equally as with the things. But the key is it's pasture. And I want to make the definition is, again, Australia's given this wrong, other countries do, so terribly, is saying, hold on, but some people say homegrown forage. So if I grow my own maize silage and I do that at a good price, is that a good thing? And I'm saying absolutely not. There's a homegrown maize silage or homegrown non-pasture is hugely more expensive, including the cost to get it down their throat, because then you conserve it. There's a whole bunch of wastage to get it out of the paddock. You conserve it. You've got to run machinery. You've got to run people. It all depreciates. It all goes in. And in fact, I've calculated for many years that grow maize silage in the paddock for one cost, a good farmer will deliver it for 50% more price. A good farmer, 50% between it, but they get it down their throat. So all of this is about pasture. I only add in green feed crops grown in situ, as I said, because it was impossible to split out reliably. I grew 8 tonne of a turnip crop, but did 5.5 tonne go down their throat, and it's part of a pasture and yield program in almost all cases. So I hope that's clear. I don't like homegrown. Homegrown's a good description, but it's the wrong one. So too many Australians are saying, homegrown forage is what I want to do. We need to calculate the percentage of pasture in the diet in a certain way, back calculation, and you want that. You want to set some targets and calculate what that is. If I have a choice of growing maize silage and I can grow it at a much lower cost than if I purchase it in, with all costs involved, I might do it, but it's a totally different decision and not a good one necessarily to even have. Do I even want maize silage, or could I remove half the maize silage as the South Africans looking to do, and by getting my stocking rate right? Okay, sorry.
Yeah, and we'll make this the last question. How can farmers use pasture production and carbon sequestration of grass to counter current environmental negativity surrounding the industry? Any worldwide examples?
This is out. You might want to pick another question quickly, because I'm going to dodge this one. This is not my area of expertise. My area of expertise is entirely around how do farmers become more profitable, not necessarily how they react to a myriad group of climate things, and be better people to ask that question to. Sorry.
Right. So we'll go on to the next one then, which is milk quality. Some UK contracts are liquid with no benefit for high fat and protein. Some are paid on kgs of fat and protein. So given a higher income to lower yield, is this an issue for in the UK?
That's I'll try and make it, I'm sure I'm grasping the full part of the question. I know that, for instance, in some of that data that I've been showing, the stuff, South Africa is similar in that they have it's mainly, there's some components in their milk price, but it's very strong related, so it could be lower fat and protein, and as the question's asked, it's the same in Argentina to some degree, and yet all the data I'm seeing supports exactly the same thing. All I would say is if you're analysing your business and you're using milk solids, which only a few, New Zealand does totally, and some other countries use partially, there's no need to use milk solids. In fact, you can see I'm most familiar with that, but for anything international, energy corrected milk litres is even, if I look at milk solids these days, I'd look at energy corrected milk solids to make sure. So all I'll be saying, it's not really, I'm saying really it's not, the interesting thing is these principles stand up under any of these, no matter what the principles of how to lower cost of production, increase profit margin stands up just as much in flatter milk. You're getting more past, there's no requirement. People think with domestic milk supply and flatter milk supply curves that you have to have more concentrates and less pasture in the diet. And it's just not true. It doesn't matter where you do this. You can flatten supply curves. You might still have slightly higher costs because you're going to move a bit more grass out of when it grows to other periods, and that's at a cost, but your milk price is higher when you're on a domestic flatter milk supply curve. So all the principles stand up, and if I'm looking at it, and of course each individual should analyse their business. If you're using litres, get familiar with a calculation to do energy corrected milk, because there are a whole number of the ratios that I try to highlight where if you don't calculate energy corrected milk, those correlations that I showed, for some of those, they substantially reduce if you don't use energy corrected milk. And for instance, the paper, I highlight those ones, which if you don't do energy corrected milk, and you could use solids rather than straight litres. Anyway, sounds like we might need to close this up. So thank you very much.
Yeah, thanks a lot, David. That's been very helpful. And for everyone whose questions hasn't been answered yet, please keep an eye out on our Facebook page and our website. And we'll put links up to the website, and we'll get this video up as soon as possible, and the questions answered as well. So we'll take note of the questions that are left there, and we'll get them through to you, David. Then hopefully he can answer them as soon as possible as well. But thanks a lot, David. And thanks everyone for tuning in. It's been great listening to you speak tonight. Wealth of knowledge, and hopefully everyone's taken away some sort of pearl of wisdom from what you've said tonight, and be able to use it to increase your profitability going forward.
Yeah, thank you. I hope so.
No problem.